Hello friends, a very warm welcome to all of you. Today through this video, we'll take a look at the company Bata India Limited. Now why Bata? Why should you be investing in the entity Bata India Limited? So we'll take a look at few points which try to communicate this message. Point number one, favorable demographics. Well, as a country, India, we are pretty young. We have crossed a key threshold of $2,000. We'll come to that in a moment, why that is important. And very importantly, we have a very high proportion of working age in India. Secondly, it's about the growing retail sector, the sector to which this company belongs. The sector is slowly transitioning from one which was dominated by unorganized players to a lot of organized players. Also, the per capita consumption of footwear in India is so low that there's a lot of headroom for growth over there. Point number three, brand legacy. As I told you, it's a 90-year-old brand in India and very well entrenched in the psyche of the Indian consumer. You just can't miss the name. You know the name. I'm very sure about that. Point number four, brand repositioning. The company has aggressively worked over the past few years to reposition itself from the one manufacturing old man's shoes or school shoes, to a company that manufactures premium, youthful and even aspirational brands. By doing this, it has also introduced quite a lot of brands at every price point. And in order to communicate the message, the company has used smart advertising campaigns involving celebrity endorsers. Point number five, strong parentage. As I told you, the parent is the world's largest shoemaker. So that's a big plus. At the same time, it is spread across 90 countries through 5,000 stores. So that gives quite a lot of confidence. Point number six, strong balance sheet. The company over the years has carried out operations in a very efficient manner. We'll come to that in a moment, but the main takeaway is that it has a debt-free balance sheet and a steady free cash flow generation, which is very important in times like these and at all times basically. Point number seven, a strong store count growth. Well, in order to remain top of mind and in order to serve your customers effectively, you need to be near them. So what do? You keep on increasing your store count. You do that efficiently. That's very important. And in order to remain relevant, you have to keep on renovating your stores as well. So that's exactly what this company has done. Point number eight, premiumization. The company over the years has continuously increased its average selling price, either through direct price hikes or by introducing new brands across aspirational price points. While doing that, it has also weeded out or removed whatever non-profitable SKUs it's had. Point number nine, raw material tailwinds. Well, given its premiumization drive, the company has been steadily moving from those plastic or rubber-based products to leather-based products. So what it does is that it reduces the company's dependency on crude oil. Having said that, crude is still a key raw material and the current low crude regime will certainly offer margin tailwinds for the company. Point number 10, successful turnaround. As I said, it wasn't very hunky-dory all the time for the company. However, whenever there was any financial turmoil, the company got its act together and it emerged stronger from that. It also increased contract manufacturing to labor in order to reduce their dependence on labor unions. First of all, let's come to the favorable demographics in India. Well, the GDP per capita of India has recently crossed a key threshold of $2,000. Now that is a very important threshold. I'll tell you why. Studies have shown that whenever the GDP per capita of a country crosses $2,000, its discretionary expenditure increases exponentially. Also, the working age population in India, the people between 15 to 65 years of age, are as much as 67% in India. Also, we are a very young country. If you consider the median age of population in India, it's just 28 years. Now, if I look at the Indian retail industry, it has grown at about 10% CAGR in 2013 to 18. Going ahead, it is expected to grow faster at about 12% CAGR. So this is about the retail industry in general. More importantly, the unorganized sector in this retail is as high as 88%. Now, if I look at the footwear industry in India, specifically, we come to the market that Bata caters to, which is the footwear industry. It is almost a 500 billion rupee industry, of which 64% is the domestic market and 36% is the export market. So the domestic market is much large. But if you look at the volume-wise data, that is, we are a 2 billion pair industry in India, out of which 94% is domestic and only 6% is exports. So a large chunk of whatever India produces is consumed here itself, domestically. At the same time, the per capita consumption of footwear in India is very low. It's just 1.66. That the organized segment, which was close to 25% in 2009, is currently as much as 40%. And going ahead, over the next 10 years, say by 2029, we expect the organized industry to become as much as 60% of the total market. Now, let us take a look at some of the brands that come under Bata. What the company has tried to do, as you can see in the next slide, is that it has tried to cover a lot of price points. From products starting as low as less than 300 rupees to products going as much as 10,000 rupees. Also, the size of the store is something which is very important. The company has consciously worked towards increasing the size of its stores. It has guided in the past for a store expansion count of close to 65 per annum. It guided this in FY16 and over FY17 to 20, it exactly achieved that. So that gives us quite a lot of confidence as analysts. At the same time, we expect that this number of store expansion will be close to 70 to 80 stores per annum going ahead. When I say going ahead, I mean from FY22 onwards, when we can expect some normalization in the business. Growth of the company, the revenue growth, was almost entirely driven by this premiumization trend. At the beginning of the century, the company plunged into losses. And there were quite a few problems. There were labor union issues. There was, disruption in its manufacturing facilities. So what the company did at that time was, it increased the proportion of contract manufacturing. What that did is, if you increase the contract manufacturing, your dependence on your own labor force goes down. Using this strategy, the company came back very well. From deep losses in the year 2004, the company successfully turned profitable in the subsequent years. We have restricted our discussion to the company versus Relaxo. What you will see is that over a 10-year period, Relaxo has moved much faster compared to Bata. Why has that happened? Is because Relaxo started from a very low base. If you look at the 5-year growth in terms of the revenue, EBITDA, PAT and the stock return, you see that it is mostly comparable for these two entities. Whereas over the past 3 years, Bata has outpaced Relaxo. One thing which we want to tell you is that Relaxo is also a very well managed company. It also does not have too much debt on its books, and it has also given very good stock returns to its investors. But there are some things which give Bata a slight edge. One is the expensive valuation that Relaxo is currently trading at. Secondly, the premiumization drive that Bata has taken upon, which will help it to continuously increase the price of its products. And thirdly, the length and breadth of Bata's products compared to its competitors. Let us take a look at some of the key financials of Bata itself. If you look at this table, you'll actually see quite a lot of data. But there are specific points where I want to draw your interest. Firstly, take a look at the 5-year CAGR for the adjusted EPS or the adjusted PAT. Over the past 5 years, the EPS has grown at an 18% CAGR. Over the next 5 years, we expect the rate to remain same, that is 18% CAGR. Now, is this special? I would say yes, it is. That's because the period from 20 to 25 also contains the current turbulent period that we are going through. Hence, maintaining the historical CAGR of 18% is quite an achievement in our opinion. Secondly, it's a debt-free company. Now, if you look at the row which says total debt, you will find that there is a number over there. It's not zero debt. But what I want to tell you is that this debt number which you see is not actually debt. It is actually lease liabilities which have got created due to implementation of the recent IND AS 116 accounting standard. Now, what is it that I will get if I invest in the share of Bata? If I take a look at the FY20 to 25 EPS CAGR, that is the rate at which the earning per share will grow over the next 5 years, we have taken 3 scenarios wherein it will grow by 18% CAGR, 21% and 25%. 18% and 21% are the most probabilistic scenarios given the current condition, whereas 25% is a slightly optimistic scenario. However, it is not extremely optimistic, it is quite possible. At the same time, if we attach a multiple range between 45 times to 55 times to the company's FY25 EPS, we can expect the stock to deliver between 2.5 to 4 times upside over the next 5 years. Now, this multiple range of 45 to 55 times is something which the company has traded on an average over the past 5 years. There will be some risk which this company, or for that matter any company, will have. We'll take a look at them one by one. Firstly, what if there's an extended slowdown in the economy? Like if the current situation, I hope it doesn't worsen, but what if it worsens? In that case, first of all, the spending will drop. At the same time, customers will stay put with lower price products. Second is the disruption that its store opening could face. By store opening, I mean the unlock-led opening that Bata is seeing. Thirdly, the fluctuations in crude price. While the company has been steadily, decreasing its dependence on crude and crude derivatives, still 50% of its raw material basket is dependent on crude oil derivatives. And finally, the competitive intensity. Well, this sector, like most sectors, does face a lot of competition. At the upper end of the spectrum, you have competition from the likes of global brands, say like Nike, Reebok, Skechers, Asics, and so on. At the lower end of the spectrum, you have competition from the unorganized players. Well, that was it from my side. I hope that you found the presentation to be useful. Thank you and happy investing.